Ladies and gentlemen, welcome to the second day of the 14th AFD International Research Conference on Development, the Visible Hand. For people who are just joining us today, I'm Asha Sampath, journalist and Masters of Ceremony for, this international gathering. Yesterday, there were around 1,000 people who joined us from all parts of the world to explore the role of PDBs, public development banks, in the achievement of the SDGs, the Sustainable Development Goals. With the contribution of brilliant economists, financial and development experts, we have elaborated approaches and solutions to scale up the alignment. We have looked at best practices, examine concrete recommendations which will be further debated by a range of policymakers during the first Finance in Common Summit, which will officially start tomorrow. The summit aims at uniting all the international development banks in a common movement to collectively act towards a fair and sustainable future for our planet. Today we will deep dive into a couple of crucial issues to achieve this objective: the public development bank's governance and the status of the global development finance architecture. I would also like to remind you that you can download the 16 research papers, policy briefs and videos which will fuel our conversations on the Visible Hand platform. We count on you obviously to participate in the discussions. You can do that through the platform. You've got a send a message box where you can address all your questions to the speakers, and a couple of them will be picked at the end of the panels. And you will also have the opportunity to get in touch with all registered participants through the live chat tool on the platform, so make the most of it. Finally, please don't hesitate to share your insights and to spread the word about the event on social media platforms using the hashtag VisibleHand4Dev. Before we delve into the discussions today, I would also like to thank our academic partners without whom this event would not have been possible. So we have the Institute of New Structural Economics at Peking University, the Institute for Sustainable Development and International Relations, and the Foundation for Studies and Research on International Development. And now I would like to turn to Ms. Stephany Jones and Ms. Jiajun Xu, who will start the day with an introductory dialogue on unleashing the potential of development banks. So Stephany Griffith Jones, who was here with us yesterday, just to a quick brief presentation. So Stephany is the Financial Markets Director of the Initiative for Policy Dialogue at Columbia University, and Jiajun Xu is the Executive Deputy Dean of the Institute of New Structural Economics at Peking University. They will give us an overview of the diversity of the public development banks, their economic role, and the potential for a sustainable recovery. Hello, ladies. Thank you for joining me.
Thank you very much, Asha.
It's great. It's great to see you again.
Excellent seeing you, and especially after this wonderful day we had yesterday. Delighted to be starting with Jiajun the first session. In spite of the global renaissance of public development banks, academic research has been rather limited, and therefore it's fantastic that Remy Rioux and Regis Marodon had the clarity and the vision that to realize the full potential of development banks for achieving the SDGs, research and science was so essential. And therefore we have this international research initiatives on PDBs led by Jiajun, by Regis and myself, with a number of researchers from all around the world aiming to create a sort of international community of academics and experts interacting with policymakers and CEOs of development banks. And we aim, therefore, to deliver concrete proposals and recommendations for decision makers, working, as I said, very closely with the public development banks themselves in all stages of our research. We do interviews with them. We have working groups, which they have similar working groups, and we coordinate our results and discuss their very interesting papers. And these groups are on SDG compatible investment, on business models, on governance and regulation, and on global development financial architecture. These are all topics that we are discussing here today and yesterday. So I want to highlight some of the policy recommendations, and Jiajun will finish. So I want to stress first that NDBs are already major actors nationally and internationally, with over $11 trillion of total assets and over $2 trillion of lending each year, which represents about 10% of global investment. So they have already very large financial power, but we feel that it can be further enhanced. In the first place, we feel that existing PDBs should have sufficient scale to perform their functions. And particularly all regional and sub-regional MDBs, which had their capital so significantly increased in the 2008-9 financial crisis, need urgent and significant capitalization in this far worse COVID crisis, which is threatening to cause a severe setback for the SDGs. We think that countries that do not have PDBs, which are rare increasingly but still exist, should definitely create national development banks, and also that existing NDBs need further capitalization. Some of the funds actually mobilized for COVID could be devoted to that end. And I think the EU provides a valuable example of how it's channeling some of its COVID recovery fund via the European Investment Bank. And this can be supplemented, that's another conclusion of our research, by MDBs, donors, and climate funds increasingly using NDBs, especially small ones in poorer countries, to channel significant funds. And of course, all public development banks need to help and further catalyze and mobilize private sector funds to further increase their scale. And another conclusion from our research is that once goals are defined, for example, for climate action, public development banks need to take a very proactive role, acting as first movers to help overcome uncertainty and risk by, for example, pioneering funding of projects in new sectors and showcasing them to the private financial sector to follow, as has been done, as well as more broadly helping define new missions and programs to achieve the urgently needed structural transformation to greener and fairer economies. So with this, I turn over to Jiajun to continue our presentation. Thank you very much.
Thank you, Stephany. So apart from scaling up the capital and being a public entrepreneur to shape the future, as Stephany just elaborated, we have three more policy recommendations. And the third one is to apply the appropriate regulatory frameworks for public development banks. The starting point of our analysis is that public development banks should be regulated properly for three purposes. First, maintain financial stability. Second, incentivize long-term and climate-resilient investment. And third, to guard NDB against undue political intervention. However, the prevailing international banking regulatory framework, the Basel Accord, is ill-suited for this purpose because Basel is designed to regulate commercial banks without taking into account the distinctive mandate and business models of development banks. For example, unlike profit-driven commercial banks, development banks have the official mandate to fulfill public policy objectives. Most development banks do not take household deposit, hence they do not in the national payment system. But based on our survey of the representative NDBs worldwide, we realize in practice, national regulators may take the Basel Accord as a benchmark model to regulate their national development banks because there's no viable alternatives. And our research shows that full compliance with the Basel Accord would undermine the ability of development banks to provide long-term and high-risk capital. And therefore, it is of paramount importance to design a tailored regulatory framework on an international level. There are two important points in this approach. The first one is has to be rule-based instead of granting discretions or waivers on ad hoc basis, which which will undermine the operational autonomy of NDBs. And the second important point is that we need to demarcate the operational boundaries of NDBs in distinction with commercial banks, and also to coordinate the regulatory framework across national jurisdictions. This will help to avoid the regulatory arbitrage. And our fourth policy recommendation is to design appropriate financial instrument to address different types of market failures and to give preference to the financial instrument that maximize development impact. So there are at least two types of market failures. The first one is credit demand failures, where investment will generate positive externalities. And the second type of failures is market supply failures, which is due to the shortcomings or imperfections of private financial system. For example, the private commercial banks may be too risk averse, or the loan repayment system is very poor. And our research has shown that when designing the appropriate financial instrument, the rule of thumb is as follows. The soft loans is most appropriate for addressing the market demand failures in case of positive externalities, and they are very effective in promoting financial returns. By contrast, guarantees are well positioned to address market supply failures in times of high risks because they are very selective. They can enhance the creditworthiness when most needed. So we would recommend the practitioners in different banks to follow the following three steps. Step one is to identify the nature of market failures, where they would leave the very good project underfunded. And step two is to design a suitable financial instrument in line of this rule of thumb. And step three is to, if there is any deviation from this rule of thumb, to assess whether there are some actual financial frictions that justify such deviation. And last but not least, our final recommendation is that we should build a global coalition of public banks that committed to achieving equitable and sustainable structural transformation. Because on the one hand, we realize that it's very important to create synergies among different layers of different banks because they have different competitive advantage. For example, the collaboration between multilateral banks and national development banks through own lending can help to enhance the SDG related finance by combining the international resources with local knowledge. So this is very important collaboration, which is particularly important for NDBs in low-income countries, which are often undercapitalized, but face very pressing financing need. On the other hand, such collaboration may also result in some balance of payment problems for host countries. If the hard currency denominated own lending hardly generate any export to help host country to accumulate foreign reserves. To mitigate such kind of pitfalls, we recommend the following three recommendations. One is that MDBs should have to foster the export-oriented project in host countries if they want to provide own lending in hard currencies, or they can increase the refinancing to NDBs to allow them more time to repay the loans in hard currency to MDBs. And thirdly, they can also provide the credit to local currencies and try to issue local bond and to help to mitigate such kind of currency mismatch. So we come to the conclusion that different banks should operate as a system. They should go beyond the isolated initiative because this is essential to tackle the problems on a global scale. So do not isolate it and try to integrate the community of public different banks. And these are the recommendations based on the 28 core researchers of our international research initiative. We hope this can be the beginning of initiating a policy dialogue like this to help us to unleash the potential of different banks. So back to you, Asha. If we have time, we are very happy.
Yes, of course. Yes, Jiajun.
Yes.
Thank you for these insights, both of you, Stephany and Jiajun. So we have, I think the audience is being a little bit shy. We have a couple of questions, but you can send us more. Feel free. And these ladies have lots to share. So if you have more questions, feel free to send them via the platform. So I have a question here, Jiajun. Maybe that's for you. So what kind of instruments do you recommend that could be, created to maximize development impact? Do they change according to the nature of the bank, more multilateral, national? What would you like to say there, Jiajun?
I think it's very important for us to, analyze this question from a dynamic perspective, because the financing needs will change for countries at different stages of development. For example, if I'm at early stage of development, I try to upgrade some industries whose technologies has already been mature. In such scenario, maybe, soft loans can be provided to overcome the first mover challenge. And on the other hand, if we are at the technological frontier, if we try to innovate some new technologies which has entail huge uncertainties, in such cases, maybe equity investment is more helpful, and which can help PDBs to also capture the upper side of such investment. So public banks should, adapt their toolkit as they face different financing needs. Yes, back to you, Asha.
Yes, thank you, Jiajun. So maybe we have 1 minute approximately left. So maybe, Stephany, a question for you. So how can we merge or attempt to promote more private sector investment in risky sectors such as agriculture through the use of risk mitigating measures such as WRS, factoring, and facilitation of trade finance? So would you like to take that one, Stephany,
Sure.
please?
Well, clearly catalyzing private investment is an essential aim, and we want to increase private investment flows that are jointly channeled by development banks. In our paper, actually, we concluded that there are perhaps better ways of doing that and less good ways. So, for example, if development banks, can capture funds on the international and national bond markets, can fund themselves on the private capital markets, that's an excellent way, because then they can channel the money through their loans and equity to the sectors that are key. Secondly, they can co-finance with the private financial sector and with private investors. Again, the private sector will be jointly working to meet the Sustainable Development Goals. And thirdly, they can on-lend through commercial banks or other intermediaries. If they do that, they have to be careful that the priorities which are defined by the SDGs and by the national plans are implemented by the intermediaries, which is important. But it has important advantages. For example, if you want to lend to SMEs, in remote areas where you don't have so much expertise, a sub-national development bank could be very valuable, as we heard yesterday. And finally, there's some more risky ways of doing it, which we discussed yesterday through financial engineering, which may imply more contingent liabilities for the public development bank, and also may make it more difficult for them to exercise policy steer.
Thank you. Thank you very much, ladies. Thank you, Stephany. Thank you, Jiajun, for this great start of the session today. And very comprehensive introduction. And we'll probably catch up some other time. Thank you very much.